We are Equi. Jeremy is a little bit more than a lowly moderator. As he said, he's one of the co-founders here at Equi, and he's also started some successful ventures in the past. One of them included one of the most downloaded marketplace apps in the country. So I think he's done a little bit for himself than just being a lowly moderator. Let's continue that into here. So a quick market update. Market has been on this substantial recovery rally over the last couple of weeks, I would say, maybe 2 or 3 weeks. And looking from low to high, we've done just about over 11% in an incredibly short period of time. It's actually been one of the stronger rallies. And I will offer today a non-conventional explanation for the rally from some of the stuff I've seen, and we can discuss this. So putting this rally in context, rate of change, ROC, just about 10% in 10 days. So 1% a day for 10 days, a very, very powerful rally. Not last time we've seen anything close to that was the recovery from COVID, which was also a very substantial move up. And prior to that was the Fed pivot in December 2018 when they backed off quantitative tightening and resulted in a big rally as well.
So Itai, a percent gain a day keeps Jerome Powell away, or are we going to find out otherwise today?
I would say 1% a day makes Jerome want to come and play.
Whoa! Did we just really go there?
Did you guys come up with that on the spot? Because that was really good.
That was actually on the spot. This
last
few brain cells we had.
This is not trained.
Making Rob Ross proud, improv.
Oh, and a big shout out and happy birthday to Rob Ross. So a little clap. It is his birthday today, everybody.
Happy birthday. So on March 18, there was a very, very large event called Quadruple witching, which really means that it's the expiration of futures and options and other derivatives that take place on that day. And it was quite a large one. On that Friday, we had about $3.5 trillion of notional options that expired, which created a really interesting feedback situation in the market. What do I mean by that? Let's talk about Gamma for a second. I don't want to go too deep into the derivative rabbit hole, but what's important to understand is that Gamma is basically a second derivative in options, which relates to the rate of change of delta. Instead of getting too deep into the Greeks, let's talk about a specific example. Let's say you own a call option on Twitter, and today happens to be expiration day. And let's say Twitter is trading at $95 and your call option is at $100. So unfortunately for you, your call option is not worth much, knowing that it's going to expire in a few hours. And then very fortunately for you, you find out that Elon Musk decided to buy almost 10% of the company, which caused the stock to soar in a very short period of time. So what happens is that all of a sudden the stock becomes in the money and the delta really changes because it goes from almost being worthless to all of a sudden being worth a lot in a very short period of time. So imagine the poor market maker that was on the other side of that trade. They had a very small notional position. They had to almost not hedge at all. And all of a sudden, as that stock becomes massively in the money, they have to offset that position by doing what? Buying more Twitter stock. And the higher the option goes up, the more Twitter stock they have to buy, which is why the sensitivity of these things going into expiration is higher. So with that in mind, we can understand some of these negative and positive feedback loops that happen in the market. So on the negative side, if people are buying a lot of puts because markets are going down, the dealers have to hedge this position and then they sell futures to do so. And then the dealer selling causes more liquidation, which is in response cause people to buy more puts. So ahead of that March option expiration, we had a lot of imbalances in the market. And that was mainly because this is the put to call ratio. So in this orange line, you see the S&P, and in blue, you see the put to call activity. So the higher it is, more puts, the lower it is, more calls. So as the market goes down, there's more put activity that takes place. So as long as that put activity continues, the market's grind down continues, as that causes that negative feedback loop to continue. But then what started happening here, it was actually around the Fed day. Some people were dropping their hedges for whatever the reason was. And it caused a feedback loop in the other direction, where people were actually closing their puts, they were selling the puts. So that was putting dealers in a position that they had to buy S&P futures. And then the entire thing exploded in the other direction into exactly that quadruple witching, and then created a positive reinforcing cycle for quite some time.
So you're talking about these situations now where if somebody has to buy a bunch of, let's just say they basically have to buy a bunch of calls and then hedge by, if they're buying calls, how do they hedge again?
Yeah, so it's actually different in this case. So it's in this case, people had puts because they bought them here.
Correct.
And then in this situation, they closed the position by selling the put when they dropped the hedge. So if dealers are short gamma and people are selling the put, the dealer takes the other side of it, which is a long put. A long put position is a bearish position. So how does a dealer hedge a bearish position? They buy S&P, or they buy S&P. And that causes an upside swing. So it's important to realize that when dealers are short gamma, it can basically go in both directions in a very violent manner, but both on the downside, as long as people keep buying puts. But when people actually close those puts and investors close those puts, it can actually go in the other direction. So a little bit of a non-traditional explanation to the rally, but we've definitely seen some of that in the market mechanics, which I think is really, really interesting, because you have to realize that the derivative market is so large now. When you have $3.5 trillion of notional expiring all at once, it can cause very substantial movements in the market effectively. And you can see that here too. In this case, this is the Nasdaq. In orange, it's where dealers are flat gamma. So above this, it's actually long gamma. So they sell into an advance and buy into a decline. So it actually reduces volatility. But when they're short gamma, they actually sell into a decline and buy into an advance, which exaggerates the volatility. And it's interesting to see that the Nasdaq really moved up back to that flat area and kind of stalled since, as it's searching for kind of a new real fundamental direction. In my opinion, this had to do a lot with, market dynamics and positioning versus, let's say heavy institutional buying that I think we've seen less evidence of that happening.
I think the thing also to point out is that as options get closer to expiry, their gammas start going crazy. And then when you have this kind of like triple witching and you have all this kind of activity, it just gets even more pronounced because the gammas are just so spin out.
That's exactly right. And this is exactly the kind of climate that you could see very, very, very large moves in both directions, really.
Itai, question for you that came from the audience. Why would this run up, let's say in the S&P 500, this kind of like this unwinding of the puts, why would this take place over 3 weeks and not a shorter amount of time?
I think the beginning of it was definitely to do with this unwinding of positioning into the expiration, but then reflexivity comes into play too, because now people see that the market has gone up and they keep buying into the market because the market has gone up. So it becomes this circular logic, and then it kind of continues until I guess it just dries out. But also keep in mind that when the market was the most short gamma, the moves were the largest, right? And as the market got closer to this flat area where dealers are no longer in a short gamma position, or not as much, then the moves became a lot smaller.
Okay, got it.
Okay, any questions on this before we move to some of the next topics? I guess not. So when we look at this, I've been asked to, and it's kind of an interesting experiment. Where is the next direction, right? So what we can expect. And I think it's important to understand that in some sense of the word, the Fed put, or the famous Fed put, has potentially turned into a short call. What do I mean by that? So the regime is still very different than, let's say, March 2020 or December 2018, where the Fed was actively supporting the rally by maintaining accommodative and easy monetary policy. And the Fed has really embarked on some of the most aggressive tightening we've seen in a very long time. And what worries me is that when the market rallies in this kind of way, that signals to the Fed that it's okay to proceed even faster, because the market is seen to be okay with this, right? Because in a way, the only way in which the Fed can reduce the rate of tightening is if the markets were to fall. And just to put this in perspective, the QE era is really an unprecedented type of experiment where the Fed's balance sheet post-COVID is about 42% of GDP. Post the global financial crisis, it was only 15% of GDP. So it's really, really important to understand what the Fed is doing, because the implications of the Fed actions, I think, are equally as important or more important than most other factors out there. And we've seen this with the following chart. So what you see here is the MSCI World Index starting in 2009 versus the balance sheet of the four largest central banks, the ECB, BOJ, Bank of England, and the Fed, of course. And it's had a remarkable 0.97 correlation over that time period between the price of MSCI World and the balance sheet of the large banks. So if we know the balance sheet is going to decelerate in the next couple of years, that could have very, very significant repercussions for asset prices. Just a quick observation that I noticed too, if you look at the MSCI World versus the G4, this recent rally actually took it where the balance sheets are, given given the last few months. They still are moving up. They have not rolled over yet.
Itai, do you want to remind us what the G4 is again?
Yeah, so it's the Bank of Japan, Bank of England, ECB, and Fed.
Cool, thanks.
Sure. So you can see here the QT plan, or how that looks to come about. And there's two ways in which it can work. There is the passive runoff, where bonds mature and then the money disappears from circulation. I'll explain that in a sec. And then there's obviously the active selling, which seems unlikely at the moment. Either way, the balance sheet is going to move from just south of $9 trillion closer to $6 trillion by 2024. And that implies $100 billion a month of quantitative tightening that is going to take place this year and next year. So,
and let's just remind everybody about how the mechanics of that would work. Basically, the Fed is sitting there with all these bonds that they have on their balance sheet. When the payments come due and they receive the payments, it's going to go into their bank account, and then magically somebody's going to click delete, and that money is going to disappear from the supply entirely.
Just like they clicked enter to make it come into the world, right? That's exactly right. So they buy bonds from the US Treasury. The US Treasury pays the principal back at maturity. Fed hits delete, that money disappears.
It's exactly how it works. And that's going to happen over the course of the next few years.
So it's the David Copperfield global finance.
Magic.
And I think one of the things that I think is the least or understated right now is just how aggressive the Fed is going to be. Looking here out of the CME Fed Fund futures to calculate the probabilities of where interest rates are going to be in December of this year, which is not far away. The most likely scenario, 41% of this time, is 250 to 275 basis point federal fund rate, with 23% getting to 3% on the Fed fund rate. So this is something we haven't seen in quite some time, and it's a very, very, very fast path of getting there. However, if one were to look based on the Tyler rule, which the Fed has not looked at for quite some time. So what is the Tyler rule? It's really a measurement of where the Fed funds rate should be based on a mix of inflation and employment. And if you're looking based on the current employment rate, which is extremely tight, employment rate the unemployment rate is exceptionally low and inflation is exceptionally high, the Fed is over 10% behind the curve. In fact, the Tyler rule implies an 11.8% federal fund rate. So even getting to 3%, the Fed is way beyond the curve. It's actually has never been as behind the curve as it is today.
So what's the implications of being this far behind the curve?
Yeah, that's the $1 trillion question, right? The Fed has to act very quickly to maintain credibility and rein in inflation, and it's potentially going to have consequences that we'll talk about. So some of those consequences are already this substantial drop in the bond market. If you're looking at the Bloomberg Ag Bond Index, we're currently sitting in already the worst drawdown ever at about 11%. So that's very substantial for so many different portfolios, including 60-40 portfolios that have equities and bonds together, relying on the negative correlation, things like that. Especially when now the bond drawdown has exceeded the equity drawdown.
I can tell you, firsthand, getting to speak to a lot of financial advisors and RIAs. A lot of them are just very, very scared and nervous by this. The bonds are basically supposed to be their defense in this position, and now they're drawing down faster than equities. So they're sitting there wondering what the heck are they going to do, and it's causing just a lot of stress for them.
Itay, what's the effect of this on those 60-40 portfolios?
Yeah, I think at some point this year, the 60-40 portfolio was having one of the worst drawdowns. It was close to 2008. Now equities came back a little bit, but the bonds have not come in at all.
Would you say then that right now that 60-40 portfolio should be underperforming the market for at least the near future if we're looking at rates rising?
If rates will continue to rise, yeah. But it's possible that rates will, especially on the long end, if the yield curve continues to invert, then the long end rates may not continue to go up. Especially if there's a recession in 2023 or 24.
Itay, one of the questions came through. I'm not sure if it's the right time for it now, but given what's happening in the bond market, what strategy should people be looking at this time, and maybe also what is equity doing to kind of counter some of these macro moves?
Yeah, it's a good question. Generally speaking, we've been incredibly diversified across many strategies that a lot of them are not correlated with interest rates. And then we've also performed a good amount of hedging to offset and reduce some of that volatility. But yeah, I mean, the interest rate shock definitely has implications for a lot of different asset classes. That's without question.
And we'll make sure to talk about that a little bit later tonight once we have a more free-form conversation after we're gone through the majority of these slides.
Yeah, absolutely. One of the things I think too, it's something that definitely is in the back of my mind. It's this large divergence between what you're seeing here in orange. It's the NASDAQ VIX, the VXN, versus the bond market VIX, the move. And that's really, really, really substantial. Historically, I don't think that's going to last. Either bond volatility will decline or the NASDAQ volatility will increase. I mean, keep in mind that there's somewhat of an inverse relationship between where interest rates are and the valuation of tech companies. As higher interest rates typically support lower valuations and vice versa. So it's just something to keep in mind when we're looking at those kind of macro factors. And you can really see the pain trade in March was the move up in stocks and this continuous drop in the bond market. You can see the US Treasury total return, and this is also pretty unusual. You're probably going to see that gap close at some point or to some degree. Okay, let's stop if there's any questions on any of that, and we'll go into a deeper dive into the bond world.
Let's just pause there. Anybody, if there's anything on your mind, we'd love to take some questions now. Okay, I see a question. Is it Michelle? Michael?
Exactly. Yeah. Yes. First of all, thanks a lot for this session. I mean, you should charge for that, really, because that's what banks do. So my question is about back to the strategy you mentioned of bond underperforming today. So is it wise to just go 100% on stocks until I think the end of the year or mid next year before revisiting your portfolio, or you would just suggest long-term investor to stick with whatever worked for them in the past, so 60-40 or an 80-20 or whatever?
Yeah, that's a great question. So I do think the risks are increasing in holding a 60-40 given where rates are and given equity valuation. It's obviously possible for equities to continue and make a new high and things like that. I would not recommend to not diversify and just go all into equities, but I would definitely suggest looking at different alternatives and some alternatives as a way to diversify outside of just holding a 60-40. There's room for real estate in a portfolio, there's private credit in a portfolio, and there's a lot of other things that could add diversifiers that are outside that normal 60-40.
And just a small add-on. So when you talked about the Fed getting paid all that money and just deleting it, doesn't it also hold equities, or is it just bonds that they have on their balance sheet?
They have in their balance sheet, they have mortgage-backed securities, and then they have treasury securities.
Okay.
Some central banks around the world have actually bought ETFs and other things, but the Fed has not done that yet. Probably in the next recession, I wouldn't be surprised if the Fed actually buys ETFs.
Itai, we got a question from Sid. Sid, you wanna share it?
Yeah. So Itai, what do you think about commodities in this, right? I mean, typically we've seen when this kind of things happen, inflation is high, commodities end up doing decently well. So what's your take on, in the current environment, how will the commodities sort of perform?
So commodities have already performed exceptionally well and have run up substantially. I think the easy part of that trade is probably over as well. And, just going long commodities at current prices, it may work, it may not work. And commodities may become more volatile as well. So it's a tricky question. And there are managers out there, like, for example, some CTAs actually trade commodities and they follow trends. They have performed exceptionally well. And they can also be a very good diversifier to a portfolio outside of a 60-40. This is exactly, what they do and why they have, very different correlation than traditional 60-40s.
Okay, Itai, I'm going to move us forward. I want you to teach us about bonds. We hear about them all the time. What are they? Why should we care about them?
That's a great question. So do you care about money?
As the song once said, cash rules everything around me. So I'm going to have to say yes, I do care about money.
So I think it's just important to realize that bonds is just another type of money. At the most basic part of it, that's what it is, right? You have three types of money for the most part. You have commodity money, that's your oil, your gold, your wheat. They actually have some real tangible market value because they're needed to do something. Then there's fiat, which is, money that is backed by the good faith of the governments that produce it, whether or not it's justified or not. And then you have debt. Debt is just a type of money, right? When you buy a house, it's rarely bought in cash. Maybe you put $100,000 cash and then you put $400,000 in a loan, but that loan is still money that's used in order to buy into something. And it's just important to realize that debt money or bond money is an asset right now. So when when debt is being accumulated, there's usually some kind of a boom. People consume more than they should and things like that. And it makes asset prices go up. And when it's time to pay the debt, typically that could result in a bust because there's always some kind of future payment that you need to take. Then, of course, inflation gets into play and debt gets deflated and a lot of other things we're not going to get into. But at the highest level, bonds is just another version of money. And there's actually a lot more of it than there is traditional money. So let's talk about that money supply for a second. We got our M1, M2 broader definition of money supply. There's roughly $95 trillion worth of coins, bank notes, money market accounts, saving account, checking account, deposits, all those kind of things. 7% of all that money is physical. 93% of it is, what you have in your bank account, digital type of money. Compare this to the debt money. So as far as the amount of debt, $253 trillion, or just about 322% of global GDP is in the form of debt, which is why interest rates are so important, because they control the price of everything from car payments to house payments, to international commodity financing, to almost anything. And what's the most important thing to understand is that the longer the duration of your debt, the more volatile it is, the more susceptible it is to interest rate changes. So imagine, Jeremy, I lend you money for a year, even if interest rates go up substantially, as long as you pay me back in a year, it's not going to be that volatile because I know I'm going to get my principal back in a year.
That's right.
But if I lend you money for 20 years, well, you better pay me a much higher interest rate because I need to wait 20 years until I get my principal back. But also, if interest rates go up or down at that time, the price of that loan is going to fluctuate massively, right?
Yes, that's correct.
And therefore, interest rates and the price of the bonds are inversely correlated to one another. So at the highest level, if you buy a 10-year bond, right, and interest rates go up 1%, that means that the value of the bond that you're holding needs to drop by the amount equivalent to somebody buying a new bond that just came out and the new interest rate that it's paying.
You want to maybe try this from the perspective of a real estate transaction, or maybe a house or something, because maybe that might be more understandable.
Yeah, so let's think about what just happened. Well, actually, we can look at it in a second because I actually have the mortgage index up.
Perfect.
But I think this is the most important index in the world. It's the 10-year Treasury yield, and it impacts the price of so many different things, and especially home payments or mortgages, as Jeremy mentioned. So this is the 30-year mortgage index as of April 1st, so just about 3 days ago. And the average loan for 30-year conventional loan is already at 4.95%, just under 5%. And it's crazy because a year ago, that was sitting in the twos. That was sitting at about 2.75%. So if you're buying a new home, let's say you take a $400,000 mortgage, which I think is close to an average. I think it's close to an average around home purchases today. That makes a difference of $400, $500, $600 in your monthly payment to get into the new loan, and that would inevitably slow down the housing market because affordability becomes a bigger issue.
Maybe we can talk about, well, what would the same payment look like at a 2.5% interest rate versus almost 5% interest rate, and then maybe we can kind of understand that a little better.
Yeah, so if we do a quick mortgage calculator, and let's say the loan amount is roughly $400,000, it basically becomes a payment of, at 2.5%, that's a payment of $1,580, and at 5%, that's a payment of almost $2,200.
So you have to pay $700 more a month for literally just because the interest rate went up. So of course, the end price that you can pay for the real estate would then have to be impacted by it.
Right.
So the interest rates and the prices of assets go hand in hand, because the interest rates are basically the cost of the money that you're taking to be able to buy things.
That's exactly right. And because we said that debt is money, not only that debt is money, debt is the majority of money that's out there. So the interest that you're paying on that debt has a very, very meaningful impact historically, right, with pricing of assets. So this is another way to look at the housing market. What you're seeing here is, on one hand, in the red, you're seeing existing home sales. And in the blue, you're seeing mortgage applications. So typically there would be well correlated with one another, right? Because mortgage applications are going to lead home sales, vice versa. There was an interesting dislocation in COVID where home sales went far above and beyond what new mortgage applications were. I do think that will inevitably close, but it's interesting to see that mortgage applications are actually falling down right now, which potentially is going to mean that the housing market is going to cool off a little bit. So to put the interest rate increase in historical context, I think it's important to see this going back over 100 years, going back here to actually 1900. We've been in this really unique period starting in 1980 or 1982, I believe, where we went from a 14% interest rate all the way to 1% on the 10-year treasury in COVID. And this move up is really just a blip in that long-term context. So the question is, are we going to continue with this, continuous decline in interest rates towards the zero bound, which would be good for the 60-40 portfolio, right? Because the 60-40 portfolio performed really well during since the 1980s. Or is it more like World War II, where the COVID spending was most similar to World War II, and we were ahead of 4 decades of interest rate increases? So I think it's important to just realize that the entire concept of the 60-40 portfolio is really invented and based off of what we've seen since the 1980s. I don't think anybody knows how to handle or what will happen if we get this type of 1940 to 1980 kind of, long-term increase in interest rate.
Itai, are there any immediate moves that somebody could do? I know that adding alternatives to a portfolio can actually lower the risk of an overall portfolio. Are there any other types of insights that maybe are at somebody's disposal?
Yeah, so the advice would be, if you're looking to buy bonds and you are worried over the breaking of this cycle and interest rates increasing substantially, then it's wise to stay in the short bond space. So you want to be in maturities that are 2 years, 3 years. You don't want to be in maturities that are 10, 20, and 30 years if interest rates rise, because then your downside is a lot bigger.
And does that also explain kind of the inverted yield curve?
Well, the inverted yield curve is something different, because that tells you that some investors believe that longer term interest rates will actually fall again later down here, and this will continue if a recession will happen. But that's kind of a different discussion. Okay.
If I could ask a quick question. I think on your previous graph, home sales were higher than mortgage applications. Does that mean some people are paying cash?
Yeah, and you also have a lot of investors that came into the market.
Okay, got it. Who buy and then they refinance once they've purchased it?
Yes.
Okay.
Most likely.
Ita, one question. This is Sid here. So how does inflation play into this real estate market dynamics that we're seeing here, right? So yes, it's correlated with interest rates, but with where lumber has been, with where pretty much prices are, and what's happened to the labor cost, it's not as cheap to make a $400,000 home as it was 2 years back, right? And so plus the inflation is high, so it's those two things got to be correlated in some shape or form, right?
Well, historically, real estate has been a good hedge for inflation. That is 100% true, because when you get wage inflation, then rents go up with it, and you're right, the cost of labor and things like that. But at some point, though, affordability becomes an issue as well. And when people can't afford to buy new homes, you can see it slowing down. So it's not necessarily, kind of like a bear case on housing saying that housing prices are going to fall. But typically when you get moves like this in interest rates, you at least see the market slowing down or cooling off and not appreciating as fast.
Yeah, and I think from an old perspective, so it'll be great. If you look at major demographics and the kind of homes that they buy, it probably makes sense to be, if you invest in real estate just from a rental income perspective, what that does to people's wallet if interest rate goes up, probably makes sense to be in that, 250 to 400K homes, where affordability still stays intact. The dent of the dent on the share of the wallet when interest rate goes up is not as significant, right? Just so that, like, I think that segment probably does a lot better than more expensive luxury homes. Yeah.
For volatility, well, there's a lot of geography, location. Real estate is complicated, right? There's a lot of factors, and a lot of it also depends on the location.
Yeah, and we can go into more of this a little later. I know Itai got a bunch of other slides, so I'm going to let you go back into it, and then we can pick us up at the tail end of the conversation.
Sounds good. All right, so I'll cover this a little bit faster because we covered the reverse of it with QT. But it's important to understand how the Fed really manipulated natural demand for bonds, and what it means that a lot of it may have come back, now. So what does that mean, right? The central bank creates money from thin air, and then they buy these US government bonds. That creates a lot of artificial demand that wouldn't be there on these bonds. So in the beginning, we explained how interest rates and bond prices are inversely correlated, right? So when they buy more bonds, interest rates fall, right? And the price of the bond increases. And then there's just more money around in the economy because interest rates are lower, and there's more borrowing and more spending activity that takes place, and then it boosts the economic growth, or that's the theory behind it. And then it really boosts liquidity and eventually asset prices, as we've seen. Now it obviously goes in reverse, but what's important to realize is that the bond prices and interest rates probably wouldn't have been where they were if it wasn't for that type of Fed intervention, which actually manipulates the price of money itself. So if you're looking at the total debt amount, total debt as a percentage of GDP versus interest rates, low interest rates really incentivize both governments, businesses, entities, whoever, to accumulate more debt. Because if your payment is so low, why would you not borrow more? And especially inflation inflates it away. So here in the 1930s, the zero bound, we've seen a very large accumulation of debt. And then as interest rates increased from World War II to the 1980s, debt was actually very stable. There was almost no increase in debt. And then as interest rates declined, there was this massive accumulation of debt. We obviously seen the top of the 2007, 2008. Some people look at it as the peaking of the long-term debt cycle. Not going to elaborate too much into that. And then that entire deleveraging that took place was very minuscule on a long-term perspective. And then with COVID, debt is now increasing again with interest rates. So it's when you have a lot of debt in the economy, where interest rates are is just so important because the debt load is substantial. The COVID response finally led to real world inflation, right? At the beginning, QE stayed in the banking system, but in COVID, and you can see this massive explosion in QE and in government transfers. So in COVID, what happened is that QE was no longer trapped on Wall Street. The fiscal spending, the unemployment benefits, the stimulus checks, all those things took the inflation from the banking world into the real world, and supply chain disruptions just added to it, and we ended up in a world where we have real inflation.
And Itai, let's just talk for everybody that's not sitting in the finance world every single day. Quantitative easing, the process by which the Fed injects money into the system. It used to be that it was really that cash that was coming in was really only available to the banking sector, which pumped up prices of assets. However, when we did all the stimulus packages and things like that, now the everyday people were able to get cash, and that caused a crazy explosion in CPI and costs of the items all around us. Is that correct, Itai?
That's very, very accurate. And plus, obviously, you had the supply chain disruptions too, because you had factories closed in different places, China closing their ports and things like that. So just to understand inflation shock, when you're looking at that annualized 6-month CPI change, it's just monstrous, going from below 0 to 8.3% in such a short period of time. And that's really on par with some of the larger CPI shocks we've seen. And it is true that in some instances, very, very large CPI changes in a short period of time could lead to a recession, mainly because that would cause the Fed to just tighten very quickly. So this is actually the biggest test, in my opinion, the Fed has faced since the global financial crisis when they embarked on the quantitative easing to begin with. Initially, it was seen as a big experiment, and how is it going to work? And they decided to go with it. And now the Fed is being tested on the other side. Are they really going to tighten and do what needs to be done in order to rein inflation in? And I think they're in a very tough spot. So let's talk about the yield curve right now. This is how a normal yield curve looks like. So generally speaking, most of the time, right, when there's normal economic activity, the expectation is that the economy is going to be fine over time. So interest rates in a longer time horizon are going to be higher than interest rates in the short time horizon, because as economic activity picks up, the Fed will raise rates at some point. So therefore, the price of longer term duration bonds is already going to be higher. So when you lend money to the government for 10 years, you're going to be able to get a higher interest rate than if you lend money to the government for 3 months. That just makes sense. However, you have a situation sometimes where the yield curve inverts. Why would the yield curve invert? The yield curve will invert because the short end of the yield curve is typically ruled by the Fed, because the Fed dictates the federal funds rate. But the longer term maturities, 10, 20, 30 years, is dictated more by the economy. So if investors believe that we're going to go into a recession and interest rates will actually decline, let's say 3 years, 5 years from now, versus what they are right now, they may prefer to buy the longer term maturities to lock that in, to lock in a higher interest rate, knowing that interest rate may fall. And if that happens, you sometimes see the yield curve inverting. And historically, that has been one of the most reliable indicators of a recession. And it typically leads a recession by 12 to 18 months, depending on what part of the yield curve inverts. And this is how that looks like now. So what you're seeing is the spread between the 10-year treasury minus the 2-year treasury yield, going back here to 1976. So when it's below zero, that means that the short-term maturities, or the 2-year maturity, is actually yielding more than what the 10-year would yield. And when it's here at the zero line, that means that they're on par. You get the same interest rate for a 10-year as you would for a 2-year. So what you can see here is that, let's say going here to 1990, we had an inversion, eventually a recession in 91. In 2000, we had an inversion, then we had the dot-com bust. In 2006, we had an inversion. Obviously, we know what happened in 08, 09. And surprisingly, we actually had one in 2019, a very short one, and then we had COVID. So it's almost like we were going to have a recession with or without COVID at some point. And now, of course, what's really interesting is that the yield curve is the most inverted it's actually been when the Fed is just starting. So the problem is that the Fed continues to hike rates very aggressively. It's going to make the short end rise potentially faster than the long end, but that remains to be seen, because the long end could still continue to go up as well to kind of normalize this. But one of the most interesting things to realize is that the inversion doesn't necessarily mean stocks are going to fall, because there is quite some time until a recession actually happens. And there's been really a different variety of outcomes when that happens, including time to recession. The median time to recession was 20 months from the initial inversion of the yield curve. And in 1965, it took 49 months. So it really depends, how it plays out. But we've also seen a varying degree of performance. So August 2019, obviously, we had that big Fed injection. So markets performed really well in a 24-month period. But we've seen results all across the board going from 1 month to 24 months of performance.
Itai, quick question. Is it the inversion that causes the recession, or is that just like a symptom of the underlying problem?
I think it's a symptom because at the end of the day, it's not rocket science, right? When the Fed raises rates in the short run, a lot of times, I think most of the time, it has not been able to create a soft landing, quote unquote, and they tilt the economy into a recession. That happened many, many times. You know, they like to think that they turn it into a science and they can control these things, but you know, we've seen that it was not always the case.
What's the effect of foreign governments buying our bonds? Like we always talk about China owning so much bonds. Has that changed over the last 2 years?
It actually has changed. So we've seen a lot less foreign demand for US bonds than there was prior. I think because the Fed just bought so much of it. So as a percentage, the foreign owners has become a lot smaller.
Itai, I wanted to give Larry Abrams, I saw that he had raised his hand. Larry, was there something?
Larry, how are you?
Good, Itai. Good, Jeremy. Quick question. On this chart that you have up on here right now, you're showing, you know, the time to recession in each of these situations. Are there times where the curve inverted, but then
there was no recession,
not to normal again?
Yeah. There were some false signals, but they were prior to here. So you can actually see since 1976, when we got these inversions, it did lead to recession, but the timing is what's, you know, inevitably you're always going to get a recession at some point, right? If you go,
right,
it doesn't matter when, right? If I say, even if I go in 2015 and I say we're going to have a recession,
well,
at
sure,
some point.
no. I mean, there are always economic cycles, and of course there'll be a recession, and as part of that cycle, whenever it is. But what I'm asking, that last chart, and I'm looking at it here,
Yep, you can see this here.
yeah. So I guess the situation has been that really every single time it has inverted, you know, in the last 50 years or 45 years, there has been a recession before it. You know, you don't get a lot of false signals here.
That's correct. It's been historically the most reliable recession
timing's tough, but
indicator out there. But the question is it 49 months or is it 7 months?
Well, the 49 month, yeah. Got it. Okay, thanks.
Ty, one other quick question that did come about, which is how have unemployment rates fared during these inversion periods over the past 3 cycles?
Excellent question. We'll cover that because one of the biggest arguments right now, well, the job market is really hot. There's actually something close to 1.7 job openings per unemployed person. It's one of the hottest jobs market out there. And I actually, so during the last Jay Powell Fed conference, he actually said that they want they wanted to go to more of a 1-to-1 ratio. So they actually want the unemployment rate to go up because they think it will cool off the economy a little bit, which is what they're trying to accomplish. So again, what they're trying to accomplish is, quote, a soft landing. They want to cool the economy in a way that cools inflation down and puts the unemployment rate back to normal and make the job market being less hot than what it is now. But historically, they just don't have a good track record of being able to do that, because if they raise rates too aggressively, the end recession could be more than what they expected, right? And that's exactly kind of the problem with that. So if you look at how quickly rates are going up historically, it's very similar to, so this is the current cycle in light blue. This is based on the forward curve. And then 1994 cycle, it looks very, very similar to that. And in a more historical context, you can see all these prior hiking cycles. This red is the projection of where the markets think the 2022-23 cycle will look like. And the last cycle we've been in was this Yellen-Powell one, 15 to 18, was very slow and gradual, very, very, very slow. And in 18, they stopped raising rates. And then obviously the market went up, that famous pivot in December 2018. And this is on par with 94, 95. This is actually faster than the rate increase in 99, 2000 that broke the tech bubble. And it's faster than the 04, 06 that ended up breaking the housing bubble. So it really remains to be seen how this is going to play out. Current 12-month recession probability based on the historical 210 are just at 20%. And going forward 1 year, assuming that the forward market is correct and they're going to raise rates the way the forward market's expecting, you know, probability of recession for the following 12 months is going to already increase to about 40%. So that obviously doesn't mean a recession is going to happen tomorrow. Now, what's really interesting is that the forward market's expecting 9 rate hikes this year, but actually rate cuts in 23 and 24, which is telling you that that's pretty much when that forward market's expecting that recession to occur. So why is this so important? Because we've never had a hiking cycle with 160% debt to GDP ratio. The debt burden is just really, really high. So in historical context, obviously, interest rates on such a high debt burden are significant, and valuations are fairly high. Yeah, they've definitely come off over the last couple of months, but historically, they're still relatively high. And over the long run, there is a relationship between low interest rates and how high valuations get, right? We've been in a low interest rate environment for this period. So we've been in this higher plateau, higher floor for valuations. When interest rates were high to 1940 and 1980s, the P ratio valuations for stocks were a lot lower. So a lot of it depends on where interest rates end up being. And this following, if you're looking at historical performance of the S&P performs fairly well when rates are rising slowly or where rates are falling gradually. S&P tends to perform not so well when interest rates rise very, very, very sharply, or when they fall very sharply, because that means a crisis is already here. So that's why bonds are so important, and so important to watch for how quickly interest rates are repriced. I'll stop right there before we talk about some of the other recession indicators and see where we sit, see if there's any questions on any of this.
JP, I know if you're there, I know you had a question.
Yeah, I had a question. I was just wondering, as we've talked a lot about interest rates here, and I was just wondering, as you look at the yield curve, and thinking through just the way that the market's moved, and looking as an example, thinking of the Dow and how it tanked when COVID first hit in March of 2020, and kind of the crazy spikes that we've seen ever since. Really, I was just wondering if you thought that speed at which the market has just ever so quickly increased over the last couple of years has really any sort of effect when you look at the yield curve, and and I say this with air quotes, but kind of look to predict that future recession, or just would the speed of the Dow increase from those March 2020 lows to today ultimately just have zero correlation with one another? Just kind of curious your thoughts on all the movement there.
Yeah, I mean, I think first of all, the market was too oversold during COVID. COVID was like a very quick waterfall decline and recovery because of this external shock to the economy. And then what happened in March 2020, the Fed stepped in and started buying $300 billion a day of securities. The amount of balance sheet expansion was something like $5 or $6 trillion. And the amount of liquidity that entered the system, the Fed flooded the system with so much liquidity that I think that was really the main reason for that incredible increase in asset value since. And I think that is actually the root of the problem we have today, because it inevitably ended up with a lot of inflation. And now the Fed has to cool it off because they created too much of a good thing. So it definitely has its roots in that March 2020 event.
Thanks. That's really helpful.
Michael, I think you're raising your hand as well.
Yes, so just following up on that note. I mean, let's try to keep things simple. If you have a certain amount of money circling in the economy, right, to buy a specific number of goods, if you increase the money supply by 20%, would you expect inflation to be 20% as well? I'm just trying to think in simple terms.
It's a little bit more complicated than that, because there's different ways of doing it, right? So QE doesn't necessarily end up in the real system. Usually when you get real inflation, you get wage inflation. And there's also, it's more complicated than that, because you also have to factor in for the velocity of money, amount of M2. We can actually have a whole hour discussion on what causes real inflation or what doesn't, because since 2009, for example, the Fed started QE in 2008-09, and there was no inflation up until 2020 and really 2021. And the big difference is that up until that point, it was also only monetary policy, and then that monetary policy didn't end up causing real world inflation. So the fiscal policy and the monetary policy is what really made that happen.
Cool.
So what you're saying is basically there's a big part of inflation just doesn't make it in the real economy.
Yeah, in some instances it doesn't. Inflation is actually a pretty complicated thing.
Cool. I'm going to step in super fast. Itai, we have about like 6-7 slides left. Do you just want to get through it so that everybody can get on with their night, and then we'll open up for a much more extended Q&A at the end for anybody that wants to stay around?
Sounds good. Okay, so other recession indicators, we're still not seeing a recession with a lot of the leading economic indicators. Very quickly, you have the inventory level, manufacturing activity, etc. And we obviously have the yield curve, but LEI's leading economic indicators they're not rolling over. Historically, a recession is a lot more imminent when you have an inverted yield curve, and then the LEI started rolling over, like what you saw here in 2007 or in '99, and this is so far not the case. So we don't have an indication of anything absolutely imminent right now. Sentiment, however, is something really important to understand. Mainly because in the US economy, for example, roughly 70% of the US economy is based on consumption. And consumption creates this virtuous cycle where people make more money, then they go out and they buy more stuff. They buy more stuff that makes more profits for S&P 500 companies or general companies in general. And then they hire more people, and then they pay higher wages. And then we have this beautiful virtuous cycle during the boom. So when sentiments start deteriorating, it's definitely something that I noticed. And we can see that sentiment and confidence are therefore related. Sentiment usually leads confidence, right? So if the sentiments start dropping, confidence start dropping. If confidence start dropping, people buy less stuff. If people buy less stuff, then what can happen is that we're also going to see a drop in profit margins. If we see a drop in profit margins, companies will eventually lay off people, and then the unemployment rate will be impacted. So why is consumer sentiment being hit right now? Mainly inflation related. So again, best year for commodities since 1915. That causes the price of everything to go up substantially. We've seen an unbelievable increase in commodity prices. Consumer goods versus CPI. Consumer goods are up 13%, even more than CPI. So high inflation is actually hurting the consumer. So it makes sense that consumer sentiment therefore declines. And that's why we've seen a relationship between consumer sentiment, right, inverted versus the unemployment rate. So historically speaking, and this is, you obviously have noise and blips in the data, but if you're looking at the longer term trends, the consumer sentiment tends to lead the US unemployment rate by roughly 10 to 12 months. Because if sentiment starts dropping, that means that behavior and consumer activity may already be changing. If that is the case, we may be at the best of times for the unemployment rate, and unemployment may actually increase into 2023. And that actually fits that yield curve inversion quite nicely if that is the case. So watching the yield curve, watching unemployment rate, and watching LEI is something that is really important going forward. So what's really next in the most immediate term? I think a lot of it is going to be dictated by earnings. Analysts have actually lowered guidance for earnings quite a bit for both S&P and Europe. And this coming earnings season in April is going to be important to see whether or not profit margins are already being hit by high inflation, or maybe analysts just got too bearish and we're going to have a lot of upside surprises and the market could actually go back to all-time highs. So I think it's a really interesting inflection point, broadly speaking, on the macro level. That's it. I'll leave you with that.